Welcome back to another video. Today I'm going to talk about what I would invest in. Not if I were you, but what I would invest in. I'm not a tax advisor, I'm not a CPA, I'm not a professional, I'm not a any this or an any that. I'm just some guy with an opinion, and I'd like to share it with you, and you can take it or leave it. And this is what I call 5D investing, by the way, because I noticed when I mentioned this to the savvy investors, you know, the real savvy investors, when I tell them about this, it just blows their minds. It blows their minds. They don't understand it. What I'm going to tell you right now is for anybody, and it doesn't matter if you've got $100,000 or more to invest, and it doesn't matter if you only have $5 to invest. I'm going to tell you how you can do it all. You could do one or the other, you could do them both, everybody needs to start somewhere. And in terms of starting somewhere, this is a strategy that if you want to beat the big investors, if you want to beat those guys, watch this video to the end. I can't wait to share it with you. I think you're going to love it. Let's start from the top. What would I do? What would I do? So we're going to start from the most expensive. If I had $100,000 or more to invest, I would invest in one or both of these strategies. And the strategies are this. One is you buy a brandable business domain name, and that domain name is backed by the real estate. Let me repeat this. So I would buy a domain name for $100,000 or more that's a solid brandable, branded business domain based on a business that's going to be backed by the real estate where that business is going to be operating out of. $100,000 or more. I would pay for just the name, just the domain name. And I would work it with the seller and ensure that, yes, it's backed by this real estate. Yes, the value is there in the business name alone. And yes, the seller is going to be leasing it back. And I would sell it back to them. I would sell the domain name back to them. So I would buy the domain name and I would sell it back. They go from the seller to the buyer. And the investor, the buyer, the one with the capital to invest, just buys the name and now owns that name. But it's accompanied by the cash flow because the seller, and you know they've got the cash because you just gave it to them. You just bought it. You just bought their asset. So they've got that capital to invest. So let them put that to work. And if they're offering to buy that asset back from you or lease it back from you, lease it back to them. You don't have to go through the trouble of doing anything. And that's the point. And that's also the beauty of domain names, by the way. If you don't know this about domain names, you really need to think about it. Think long and hard about this. And I'm going to use an example. A lot of these big tech companies, they pay a lot of money for these domains, for these businesses. They're already businesses. And really, when I talk about domain names, think of it as a business because it is. It is the business identity. And that's how I treat it. And that's how you should think of it. That's how you should treat it as well. A domain name is a business name. It is a digital asset. It's a digital asset that has intrinsic value, whether it's just a name or whether it's just a landing page that's a website with just a basic website, one-page website, or if it's a built-out complete website or an e-commerce website that sells products and services. It doesn't matter. A domain name is valuable based on its memorability, its extension, and if it resonates. I'm going to tell you about my domain portfolio eventually. Just watch my videos. You'll see my domains scrolling around on there. You'll get an idea or a sense of what I'm involved with. So back to the domain names, back to the investments. The number one ultimate would be buying a domain name that is backed by the real estate. And I would buy that domain name for $100,000 or more. And I would collect a respectable return on investment as a monthly cash flow. So for example, if I bought a domain name for $125,000, I would lease it back, I would finance it back, or sell back to the seller, becomes the buyer now. I would sell it back to them for the $2,500 a month. I would buy it for $125,000 and I would lease it back to them or sell it back to them for $2,500 a month for 60 months. And that would be a 20% return on investment. That's what I would do. That's the first number one thing I would do. If I had dry powder of $100,000 or more, I would buy a domain name that's backed by the real estate and command a 20% return. That's very fair, it's very reasonable, and it doesn't put out that the buyer slash seller, because that's a reasonable amount, and now they can use that capital, put that capital back into work, into growing their business, growing the domain, growing the website, marketing and advertising. Everybody wins. Everybody gets value. So it's a value add proposition. That's what I would invest in first. The second thing I would invest in, other than the domain name, in that price range of $100,000 or more, would be a seller leaseback property. So I would go and buy a property for $100,000 or more from the seller, and I would let that seller lease it back from me for, let's say, 1% per month of the purchase price. That means if I buy this property from the seller, if I buy that property from the seller for $100,000, I will lease it back to them for $1,000 a month. And actually that'd be a 12% return, right? $1,000 a month. Annual ROI be $12,000, 12%. That's what I would do with the real estate side of things. Now, let me explain real quick about the leaseback proposition and why that's valuable. It's valuable because, number one, you're leasing it back to the seller, the person you bought it from. They know the property. They can fill you in with all the details of that property. And if they still want it, if they want it that bad, if they want it so bad they need to buy it back, that is very powerful and valuable. And you should really consider that, because number one, they're not running away from it. It's a different story than somebody who's trying to flip a property and get as far away from it as possible. You've got a dedicated seller. You've got somebody who's committed. You've got somebody who has, or they should have, some kind of business plan or business model or solution for the property. And what should be proposed, or what should be expected, is that you buy that property from them and they reinvest that money back into that property. You spend $100,000 into a property, to buying a property, you lease it back to that seller, and they drop anywhere from 20 to 50 to 60 to 80 or whatever $1,000 back into it, whatever it needs. Now that property becomes worth that much more. That's your safety net. That's your protection. That's your hedge in case things go south or sideways. So think of it from those terms. And the reason I would pick the domain name over the real estate is because you get the 20% return, and you're not actually dealing with the real estate ownership. So you're not having to deal with the taxes, insurance, maintenance. Just think about all this during tax season. You're dealing with one asset, and that's the domain name and the income that domain makes. And that income is predetermined upon the sale. So those are the number 1 and 2 strategies I would do if I had $100,000 or more to invest. Next, what's the third thing I would do? So we're going in order. The third thing I would do is if I had $50,000 or more, so it's between $50,000 and $100,000, this is what I would do. I would invest in a brandable domain name that's backed by the business. Maybe it even comes with the business. But this is going to be a brandable domain name that's going to be catchy, it's going to be memorable, it's going to be valuable, it's going to be a premium domain name, and it's going to have a specific location. And that location is going to suit that business model. For example, you spend $50,000 to buy a domain name .com, and the business model is, look, we've got this location that's located right here next door to this old school gym, and if you want to think about the competition is all the way over here on the other side of town. So we want to do this startup, and it's called Gym Bar. We want to offer these shakes for the weights and the weightlifters. Pre and post workout shakes, teas, drinks, you name it. But that's the business. You buy that domain name, $50,000. Now that seller has that startup capital, but they've already got the space. They've already got the space locked up or locked in. Or they own the space, and this is what they want to do within their space. There's so many different ways to utilize collateral to further protect your domain name investment. But the bottom line is this. When you're buying a domain according to these strategies, you're buying domains that have scheduled income from day one. This isn't speculation going and buying a domain name, trying to flip a domain name to a buyer and hoping to cash out some higher amount than what you paid for it. This is, look, you're paying the high amount because you've got the tenant who needs that domain to operate their business, because that's what they're going to be building their brand around. And that's the point. Everybody's adding the value. You're getting the value out of the seller who's using the funds to reinvest back into the domain, back into the website, back into the marketing and advertising. Again, that's adding value to that asset. So that's the third thing I would do. The fourth thing, the range would be between $5,000 and $50,000. This is what I would do. If I had $5,000 to invest or more, I would invest in just a domain name, just the name, and I would negotiate for the seller to lease it back on terms. 20% return. That might look like, buy this domain for $5,000 and lease it back from me for $60 a month for, 60 months or whatever the 20% comes out to. So I would buy the domain name for $5,000 and then I would lease it back to the seller for that 20% return over the course of 5 years or 60 months and get that monthly cash flow. So that's 20% monthly cash flow. Now, here's the kicker. You want to offer to sell that domain name back to that seller, because that's going to be your quick exit. So the goal for the seller is to use those funds, build up the domain, build up the website, build up the brand, get the business going, add value into their business, and now they cash out and buy you back out of the domain. Make sense? So they buy the domain back from you. That's the point. You get your 20%, and the goal is to let them cash you out sooner if you need access to that capital in 1 to 2 or 3 years instead of the 5 years. Nonetheless, that's what I would do with $5,000 or more, is invest in a domain name, but I would make sure that that seller is willing to lease it back, because now that ensures the monthly cash flow. Where can you find a real estate investment where you can pay $5,000 to $50,000 and get a 20% monthly cash flow on your return and you don't have to do anything. Like you own the name, they need that name for their business. They're paying you monthly, and it's handled by a reputable third party. Where can you do that? I mean, $5,000 would be, I'm not even sure if you can these days. I know I have in the past, but I don't know if you can today. Even use $5,000 as a down payment. We may be way beyond those numbers because of inflation. And maybe it doesn't matter how desperate somebody is to sell, or I don't know what kind of crash some of these investment gurus, some of these real estate gurus are looking for. I don't know what they're expecting, but they may be in for a rude awakening. If you're a real estate investor and you're waiting for the market to crash, you may be in for a rude awakening. If you are a real estate investor right now and you have your powder dry and you're standing by, waiting on the sidelines, waiting for this big market crash, you may be in for a rude awakening. One, you don't have to wait. And two, do you really want to wait? And even if there is a crash and there's blood on the streets and people are dumping their properties, is that a respectable way to invest? Would you feel proud of yourself for picking up a deal along those circumstances? If there's a significant crash, if there's a crash like none other, and you time it well enough to where you're picking up properties from desperate sellers for a lot less. And we can talk about fair market value all we want, but that means nothing to me. Fair market value, I don't care. I don't care what the fair market value is. I care about what the potential pro forma monthly income is and what that's going to cost to achieve that. That's all I care about. Monthly income, monthly cash flow with a bonus on top, and the bonus is going to be that branded business that's going to be occupying that space. But let's be serious here for a second. To all you real estate investors, would you really be proud to pick up a great deal? Think about all the ones who picked up great deals during the last recession. I'm one of them. And I'm not proud. I'm not happy with how it worked out. I picked up an REO, and by the way, this is something else. You real estate investors that are waiting, that are standing on the sidelines waiting for the crash. Here's the thing about these crashes. Let's say everything takes a nosedive 50% by the end of the year, in the next couple of months. 50% nosedive. Is that the bottom? Because I remember the last time the crash happened in 2007, 8, 9, 10, and I still see videos pop up and people are talking about how they picked up the bottom of the market 2011. Man, that ain't true. If you were picking up in 2011, that was not the bottom of the market. The real, true bottom of the market was between 2013 and 2015. I'm going to stick with that. 2013 to 2015, that was the bottom of the market. If you picked up anywhere before that, then you were picking up on the way down. And yes, things have come way back up, like double, triple, no problem. Nonetheless, the crash happened, and it was still a matter of years, several years after the fact, before things really leveled out at the bottom. Because it's gradual, right? It's not like it just goes down and stops. It's like it's a gradual, and then we got to wait, see how it levels off, see what people can afford, see when banks start lending, see when they start doing the no-doc loans, if they ever do that again, or whatever program they come out with to help boost the economy, whatever government program and banks they force banks to do. We're still years away from that regardless, right? Because it has to run its course. this is what I would do. Again, this is what I would do, is I would not wait. I would not wait. Now, let me clarify this. When I say I would not wait, I'm talking about I would invest in property, mainly commercial, but I would invest in that commercial property and the business that will occupy that space. That's going to be the hedge. That's going to be the bonus, so that regardless of if there's a crash or not, that bonus business that you're invested in should be generating enough income, or at least on paper, in equity and in valuation, to make up for having to wait for the crash to occur. Because this crash is going to occur, and you know what's going to happen? This is what I think would happen if there's a crash. I don't believe there will be, but this is what I think would happen if there were one. I believe that there would be so many foreclosures. If things got bad enough, there would be so many foreclosures and real estate owned properties. And do you know what I think those banks would do? I think every single bank in America or around the world would package up their portfolios and sell them to BlackRock and Blackstone. That's what I think they would do. They're not going to put them on the market and let Joe Blow investor come in and make an offer, a lowball offer, and try to get it for pennies on the dollar. No, they're going to sell it pennies on the dollar to Blackstone and BlackRock. Who are we kidding? They've already done that. They've done that before. Isn't that what Zillow did? Hello? You guys been paying attention? It's coordinated. And that's why I believe there will not be this massive crash the way a lot of fear mongers and real estate gurus say. There may be some kind of correction, but I do not believe it will be the kind of crash that they are leading on to believe. I don't think so. I may be wrong. I hope I'm right. Nobody wants to crash. But that's where I stand on the matter. You guys ready for the final strategy that I would do? If I had $5, if I only had $5, if I had between $5 and $50, this is what I would do. You ready? I would buy a digital asset that's backed by real estate. If you're thinking crypto, then everything you know about crypto, real estate, digital real estate, and digital assets has been ruined by every major investment firm, every major real estate investment trust and investment fund, all these old school real estate builders and investors that are out there, and they're trying to connect their real estate assets with crypto in some way, shape, or form on the blockchain and using ETH and minting. They've got it all wrong. They're doing it wrong. They've been doing it wrong. I've got a buddy who's really big into crypto. I tell him all the time, and he's set. He is so set on the DAO. You got to have the DAO. Let me explain something here. This is how you can do the digital real estate the way it's supposed to be and the way it should be and the way I'm doing it and the only way I would ever do it. You've got a piece of real estate, and it doesn't matter what the value is. You've got a piece of real estate. That real estate has rights. That piece of property has ground rights. It has usage rights. It has mineral rights. And if it's in the right part of America, in a major downtown city metro area, it could have air rights. You want to talk about crazy? If you don't know about air rights is where you own the air above your building. So skyscraper cities, and there's like that 10-story skyscraper next to the 50-story skyscraper. Well, that 10-story has or may have air rights. That means they have the right to build up that high as these other skyscrapers, if they have the right land mass and all things considered. But they have that right. It's called air rights. And that air rights can be expensive, and it's air. It's up in the air. There's nothing there, right? Because when you own real estate land, when you own the land, don't you own everything above, up into the sky, into outer space, on this quote-unquote globe? And then don't you also own everything underneath, straight down to the center of the earth? I mean, we're talking a little technical here, but that's the case, is it not? And that's why somebody can own a piece of property and then someone else can own the mineral rights. There's easement rights. Somebody else can own the mineral rights and have the right to come onto your property and drill. Back to the digital side, what I am saying is you have all these rights, but the other rights that you have when you own property that is overlooked by everybody, these rights are overlooked by everybody, even the most seasoned investors. That is the digital rights to your real estate property. You own those rights. You own the digital rights to your property. And there's nothing you can tell me that's going to change my mind. You own the digital rights. I call it digital square foot. I don't know what you would call it. But you own the digital rights to your property. For example, you own a piece of property. It's got an improvement on there. If you want to recreate that property, the improvements, if you want to recreate that, along with your land mass, you can create a digital copy of that and you can place it in the metaverse. Now, a lot of these crypto people, they're running around trying to figure this out, and it's right in front of them because this is what it is. We've got the real asset. We know exactly what it is because we can look at it, we can touch it, we can feel it, and we can measure it. And that's why this is so important. Most importantly, it's recorded. It's recorded. There's a tax record proof, documentation of this property. So when you duplicate it in the digital sense, you match those specifications. Oh, it's a 10,000 square foot corner lot. It's got a 2,000 square foot custom house on there. And here's the digital copy rendering 3D version of it that someday will be in the metaverse. And in the metaverse, it will live right here. And then you pick your little digital square pad on your computer screen. That's digital rights. And that's exactly what I would be investing in with $5. Is I would find that real estate seller who is willing to sell his digital rights per square foot, but it gets better, and match it, back it by the physical asset itself on a 1-to-1 scale. Here's an example. A seller of a piece of property. And, you know, to me, there's no such thing as worthless real estate. It's all about how it's used and what it's used for. There's always a purpose for real estate, right? That's why it was built. Somebody took the time to build it. I'm also a big proponent of revitalization, rehabbing, fixing up. You never want to tear down a property because it's always going to cost more to build it. You've got a seller, he's got a property, and he's willing to match his property, digitize it. Now you've got the digital square footage, and he's willing to sell it off per square foot. $5 a square foot. I would be all over that. Do you know why I would be all over that? Because that's exactly what I'm offering to do out of my real estate portfolio. All you investors out there that missed out on the last crash, there's still opportunity. There's always opportunity. You just have to broaden the horizon, broaden the scope of what you know about investing in real estate, and work with the right seller, because when it comes to real estate, there is no right or wrong. It's whatever is agreed upon. And if a seller owns his real estate and says, look, I've got my property, 10,000 square foot. It's got this 2,000 square foot building. I think it's worth $100,000. And I'll sell the digital rights to my property for $10 per square foot. So now whoever owns the digital square footage, whoever owns the digital rights, and it can be split up. This is the only way. Let me say this. Let me be very clear about this. This is the only way that I could think of where you can purchase real estate on a per square foot basis. You can buy 1 square foot, 1 digital square foot, and it's backed by the real estate. It's backed by the real square foot. I mean, you're not owning the actual real property, but since it's backed by that real property, you're entitled to the income that that real property generates. This is the power of creative real estate investing. This is the power of 5D investing. 5D as in 5D chess, because we're dealing with ideas on another level that have never been done. And for all you out there saying, well, the reason it hasn't been done is because it won't work. Wrong. It's never been done because people don't know that it can be done. But now that I'm telling you that it can, and I'll show you some examples in some future videos, it's going to blow your mind. It's going to change the way you see real estate. And that's why I'm here. That's why I'm making these videos. That's why I'm bringing you this information. And that is my duty, to bring this information out to you. I've been working on this strategy for years. I've been working on this strategy for years. Over 4 years, 5 years maybe, longer. Got notes. But this is what it's all about, and this is what it's come down to. It's come down to, we can sit around and wait for the crash, see what happens, wait for that great deal. Just wait for that great, keep your powder dry, wait for the crash, and then get in there and buy up all this real estate for pennies on the dollar. Or you can have some form of control over your investment and what it looks like and how it's going to move forward and work for you with predetermined outcome. There's always risk, no matter what. You know, there's risk that people could invest in the digital real estate, it doesn't work out, and it's backed by the physical real estate, but the real estate market crashes, and so now you got your $5 investment in this digital square foot, and you're like, man, I could have had a milkshake. I could have my $5 milkshake. You know, instead I got this crummy digital square foot. Yeah, that digital square foot could be worth $50 in the next 5 years or less. Could be. That's the power. That's what I'm trying to get you to start changing your thinking a little bit. But I'm here to help. So I'm sharing everything I know in the videos to come. Check back regularly. I will see you guys on the next video. Until then, I'm Matthew Smith, and take care, everybody.
too. You got me wondering while I ponder, heart on thunder. Is it just coffee or is it you? How I can't get away